Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on the dramatic drop in the equity markets. Author of the book The Demographic Cliff, Harry Dent believes China's one-child policy will end up hammering West Coast real estate. And American Manganese CEO Larry Reaugh on why Canada needs an Uptick rule. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Well, I won't say it's a pleasure to be back this week. It has been quite an astounding week in the equity markets. Far less volatility over in currencies than one would expect, other than over in China, where there's been a lot of currency action there. And some mild improvement over in the precious metals markets. But for the equity markets, this was as bad as it gets. We have not seen a beginning of the year start off as badly. Monday, Tuesday, we saw markets down percentage-wise more than we'd seen in many, many years. By the time we got to the latter part of the week, you're down anywhere from 5 to 7% across the board on the indices, and it's a broad-based move to the downside. It's not that selective, and I guess we should have foreseen some of this weakness that was sitting out there. We have talked about the high yield markets, the credit spreads, and how they've been rolling for the last 6-8 months in terms of showing weakness, and now it's spread across to equities. Typically you'd see the fifth year of the decade last year to be up, and managed to close the year with small loss. December, which is typically one of the best months of the year, closed to the downside. The Santa Claus rally, the mid-December through the end of the year, started around the 14th on time, but it was finished by the 29th. And we closed the last 2 days of the year on the downside, which, all is overshadowing then, or leading us to the type of weakness we saw this week. So instead of just seeing small caps having had a bounce into the end of the year and then seeing some selling, you started off the year with some of the best stocks, like the FANG stocks, the Facebook, Amazon, Netflix, and Google, which had been the star performers late last year. The profit taking started to come into those. You had that big move in China on consecutive days during the week. They had that 7% rule in place, so that when the market dropped to 7%, they halted trading. And really that just brings about more selling. As you approach a threshold level with a limit like that, then people will panic and you'll get the selling pressure right into it.
China being a centrally controlled economy, perhaps they just don't understand that governments cannot overcome worldwide market forces.
Right, and they have been trying this. They've been working with this market, well, since the middle of last year when we saw that bubble to the upside. And the market was up 100% or more, depending upon the index that you look there. And we saw the backside of that bubble and how they tried to protect it in the initial phases last spring and summer. And so these various programs that they've come out with, they're wrong. You need to allow the markets to move with their own ebb and tide. And if we look at the Chinese market and how it's unwinding in this last 12 months, it's basically a replication of what we saw in the dot-com era back in 1999 through 2000, the peak that happened there and the unwinding process. You get that first hard sell-off, you get a recovery rally that takes the better part of maybe 6 to 7 months, and then you start the next move to the downside. And to try and put a floor underneath it really is not the way to stop it. You just want to allow the market to run its normal course.
Bob, what's happening with gold and silver?
Well, if you take a look at what did manage to finish off the week reasonably well, there wasn't that flight to the safe haven items that you would normally have seen. The bond markets were up marginally, the government bonds. But clearly the winner out there was the mining market, the gold miners. We had been seeing this since the early part of December, that the miners were outperforming bullion, and bullion itself was putting in a good low. So here we closed off this week up about 4 or 5% on the bullion price, and up close to 10% on the miners. And this is what we've been talking about, that this rally should carry us through January, possibly into February. And the action that we're seeing really does fit in quite nicely with that. So the action pretty much as we have been looking for into this January-February stretch, you want to be keeping an eye on the weekly charts on the GDX and on the Canadian market, the TSX Gold Index. If we can get relative strength readings on the weekly charts there up into the 75% level, that's a point at which you want to be taking some profits on those miners, because they're doing well, but you don't want to overstay the welcome. Now, the other thing that happens, and we've talked about this last year, is that the bottom in gold tends to precede the bottom in the oil market by anywhere up to 3 months. And gold bottomed out the first part of December. Here we are a month later, and we're seeing oils having hit under $33 this week. I would be looking very closely at the oil market here in this next 3 to 4 week stretch for a potential bottom, and clearly the upside resistance level right now is around $36.5 to $37. If it were to exceed that, we could say that a base was coming into place. If it wants to work its way down into the 20s, we'll take a look for a lower resistance level to be working with. But I would suggest that having seen a good low in gold, that we are now within a reasonable time frame to be thinking about an oil low.
Ross, thanks a lot for chatting with us.
And let's hope for a better week for the investors next week.
How about a better year already?
Good day, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. You can email Ross at ross.clark@cibc.ca. Coming up next, Harry Dent on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Harry Dent. Harry's the author of The Demographic Cliff and editor of the free newsletter Economy and Markets. Now, our listeners can get a free copy of The Demographic Cliff by going to his website, harrydent.com. There is a $4.95 U.S. shipping fee on that. Harry, welcome to the show.
Oh, yeah, nice to be back.
Nice to hear you on This Week in Money again, Harry. You're speaking to us from Florida. Now, we want to talk about real estate, comparing the late 80s to today. In the late 80s, the Japanese were the spotlight. They were snapping up every piece of real estate they could find at the time. Why did they do that, and what eventually happened to those real estate holdings?
Well, the thing that people don't get is that demographics drive our economy. Japan had the first great baby boom, and they peaked in their spending in the late 80s and mid-90s. And when that bubble was peaking, they had the greatest real estate boom in the country, and everybody thought, oh, Japan's going to grow forever, and they're going to overtake the U.S. economy, and we said no. 1989, I predicted Japan would collapse in the decade to follow, while the U.S. and Europe would see their baby boom have the strongest spending surge in all of history, and that's basically what happened. So that's China today. China has become, Japan was the number 2 economy that was supposed to overtake the U.S. economy, and now they're not even 30% of us. China's now supposed to do that, and they are much bigger, but their demographics, they've had a one-child policy since the early 70s. Their demographics and workforce growth is going to slow for decades ahead. The only emerging country, they've overbuilt all their real estate, all their industrial capacity, everything for decades ahead, and then they have the biggest bubble in history, and it's going to burst. And it is bursting as we've seen their stock market start to collapse in the last several months. And even though the government is buying the stock market to prop it up, it keeps collapsing, as we've seen in the last week or two. So China is going to trigger the next global downturn, which is already set to happen due to demographics and unprecedented debt levels.
Now, of course, they've changed their one-child policy. You're allowed to have 2 kids. Is it too late to have that have a major impact?
Yeah, it is too late. First of all, children are an expense until they enter the workforce, on average age 20 in the United States and maybe 18 in countries like China. So even if they did start having more kids, which I don't think most increasingly urban Chinese will, because it costs too much to raise a kid and educate them in modern society, even if they did have more kids, it would not positively impact their economy for almost 2 decades, and it would actually negatively impact it with higher cost and inflation in those 2 decades. So yes, it would be a good thing for them to do long term. First of all, I don't think, since I've done a lot of speaking in Asia and Asian cities, I don't think it would change habits that much. But also, if it did, it would take a long time to have a big impact. So China is going to be the biggest drag on the global economy for the next decade. That's what I'm predicting, and I've been saying this for years, and nobody's getting it until now.
Right, and of course, they've run up a lot of debt to build these massive infrastructures.
Oh. Yeah, I mean, China has more total government and private debt as a percentage of GDP than the U.S., and for emerging countries, that is usually at most half of what it would be for a developed country. So China is on steroids, and they have moved 500 million people in the last 25 years from rice paddies and rural areas to urban areas with no change in skills, no education, and these people are now trapped in these urban areas, and they've been building condos and infrastructure for nobody. And when that bubble ends, these people are going to be trapped there, and it's going to be probably the greatest urban disaster in history.
Well, we see a massive outflow of migrants from them, just like we've seen from Africa to Europe.
Yeah, well, it's already happening. The difference is, in China, the rich people are leaving. The most affluent people are moving their money to places like the United States or London or Canada or Singapore or Australia or New Zealand under the guise that, oh, our children are going to high school, college, and they buy real estate because they're, for their kids, or buy real estate because they're shifting part of their business. They can get away with it. And I think the Chinese government is going to get very close to clamping down on that. They're already starting to, and saying, you can't keep leaving our country. The richest people are leaving the country, and of course, everybody's going to try to leave when they realize that the greatest bubble in history is bursting. And China is, and I will say this 10 times over, China is the greatest bubble I've seen in 250 years of modern history. And it will burst badly. There is no soft landing for China. They are going to go down very hard when they finally collapse.
Are people being overly optimistic then, trying to tie their trailer to China's economy?
Yes. I mean, everybody I debate in the media and things are saying, oh, China's government is in control of their economy. They can let the bubble go slowly. No. There's never been any bubble in history that's gone down slowly. Bubbles don't correct. They collapse. And they collapse dramatically. And we've already seen the Chinese stock market last year go down 42% in 2.5 months. The same thing that happened in 1929 in the first stage of our bubble collapse way back then. And their government's doing the same thing we did back then, buying their own stock market to prop it up, and it's not working. We've seen 2 7% collapses in just the last week. China's going to blow, and when it blows, it's going to be way worse than the subprime crisis that triggered the 2008 collapse, and stocks are going to go down around the world, including the United States, and they're going to go down harder and more. And nobody sees this coming because everybody thinks, oh, the central banks won't let this happen. I'm like, what does the Federal Reserve or the ECB in Europe have to do with this China bubble? Nothing. If the China bubble blows, it's worse than the Japan bubble blowing in the early 90s because they're buying all the real estate.
What happens to all that real estate the Chinese have bought so far?
It goes down. I'm predicting, because I look at where bubbles start and how they accelerate exponentially and where they go down to, Chinese real estate in cities like Shanghai and Beijing could go down 60, 70, 80% in the next several years. And unlike the United States and Europe, where people have more of their money in stocks and bonds, Chinese, the rich, and even to some degree the everyday person, they have 80% of their money in real estate. It's the greatest bubble in history. 27% of condos in major Chinese cities are empty. Can you imagine real estate going up in Miami or New York or San Francisco or any city? 7% are vacant? Well, Chinese just buy and they don't question it. And they don't even try to rent it. It's the craziest thing I've ever seen. But it means when this bubble bursts, there's going to be the biggest implosion of wealth in the second largest economy in the world, way larger now than Japan was, in the late 80s, and it's going to cause a domino of real estate prices going down around the world because the only reason Vancouver's going up, in Sydney, Australia, in San Francisco, in L.A. and Irvine, and New York, and London, is because the Chinese keep paying more and more money because they're laundering their money out of their country. They don't want a loan. They want to pay all cash, and they want to get their money out of their own country because they don't trust their own government. What does that say to you about China when the most affluent people are putting their money outside of the country as fast as they can? It's going down.
Well, China finally saw one of their billionaires make the top 10 richest people list in the world. How long is that going to last?
Well, again, the richest family in China is selling their commercial real estate holdings as fast as they can. I think this family's worth $30 billion, which is the top end of China. Not as rich as Bill Gates or a few people here, but they're selling their real estate. The smart money realizes that this is a bubble, and they also realize their government has been driving their economy through unbelievable overbuilding and stimulus, makes us look like quantitative easing like nothing. And the smart money over in China knows this bubble's going down. That's why they're getting their money out of the country as fast as they can. And again, they have to disguise it and say, we're just building a business in California. We're just getting our kids in a university in California or Boston or London or New York. We're not moving out of the country. We're just buying a $20 million condo while our kids go to college. Oh, no, they're moving. They're leaving the country with their money.
Well, of course,
they know their country's going down.
One of the phenomena we see in Vancouver, though, we call them satellite kids. Again, they're in a very rich piece of property. The parents buy them a Lamborghini. And of course, a 19-year-old and a Lamborghini are not a good mix.
Exactly. No, and I'm seeing, Singapore just put a huge tax on foreign investors, which was aimed at the Chinese. And in Vancouver, people living there are realizing that the cost of real estate is going so high that they can't afford to live there anymore. Same thing in San Francisco and other major cities. So you're going to see more and more major cities like Vancouver, like San Francisco, like Singapore say, we're going to put a tax on foreign buyers, but the problem with that is once those foreign buyers stop buying, which is already happening in Singapore with a 26% tax on foreign buyers, real estate starts going down. So the good side is, yes, real estate will go down and people in cities like Vancouver can afford to buy it again, but the people who own real estate in Vancouver, in cities like that, are going to lose money when these Chinese and foreign buyers, including, the Middle East and Russia and Brazil and other major foreign buyers, these foreign buyers are driving up the best cities. It's not the local citizens because they can't afford. And I every time I go to Vancouver, every time I go to Sydney, Australia, London, anywhere, the locals can't afford. They're renting. They can't afford to buy the real estate.
We're speaking with Harry Dent, his website, harrydent.com. Harry, we've seen the massive rise in real estate prices in Vancouver, Toronto, other cities. I mean, in Vancouver, single detached homes went up 30%, 36% in some areas. How long before the Chinese investors in those properties take those properties and convert them into cash?
Well, I think that because of the Chinese buying, that even as the Chinese economy continues to slow, at first, the rich people in China will continue to try to move their money out of their economies. And places like Vancouver and Toronto and Sydney and Melbourne and Australia could continue to go up for a while, maybe 6 to 12 months. But like the Japanese, when the real estate finally does implode in China, their wealth, their borrowing capacity, their outlook on the world changes when they realize their own economy and their own real estate, where most of the Chinese wealth is imploding, and they will stop. So I think in the next 6 to 12 months, you're going to see a decline in Chinese buying in places like Vancouver and around the world, and it's going to cause a global real estate collapse in the highest end markets, and then of course it reverberates down all the way to everyday houses. I mean, I've been to Vancouver twice a year for the last 7 years, and the average house is like $1 million, and it's not much. Even that will go down, but I would worry the most about the highest end condos and the downtown areas. People think this real estate cannot go down in Vancouver or New York. They are dead wrong. I study history. The greatest bubbles always have the greatest burst, whether it's in stocks or real estate or gold or commodities or anything. Wherever they bubble up the most, especially where the rich and the foreign buyers are driving it, that's where it goes down the most. So I would rather own a house in Omaha than Vancouver today.
Somewhere where prices have been moderate for some time.
Exactly, where there wasn't as much of a bubble.
So really, people who invested in housing in downtown Vancouver, close to work, they would have been better off to go out to the burbs and buy a house that was much more affordable?
Yes. Again, any real estate, any stock you can look at, my number one measure is I look at anything that's in a bubble and I say, where did the bubble start? And the bubble started in stocks in December of 1994. And it still hasn't gone back down to those levels. The bubble in real estate started in most markets around the world in January of 2000. Look at your real estate, whether it's in downtown Vancouver or out in the suburbs or in Omaha or Dallas, Texas, or wherever. What was it worth at the beginning of 2000? And that's where it's likely to go back down to, maybe lower. And if you look at that in Vancouver, you're going to be shocked. Oh my God, my condo could go down 60, 70%. And nobody expects that. But that's what history says will happen. Bubbles, when they burst, they go back, not to the beginning of the bull market, not back to the World War II or something when real estate started going up more than any time in history, just back to when the bubble started in January of 2000.
So in other words, with the price, I was going to say, so whatever the prices were in 2000, you could see that in a couple of years.
Yeah, you could see that in the next 2 to 6 years. I mean, the difference between stocks, like you saw in 2008. Stocks went down 50 to 60%, 70% in China, but, let's call it 50 to 70% around the world in a year and a half. Real estate went down from early 2006, and we called that bubble burst in October 2005, just before it happened. It took 6 years to go down in most areas. So real estate takes longer to go down. It doesn't go down as fast as stocks, but unlike stocks, if I tell people the stock market's going to go down, and they think, well, Harry, I don't know if you're right, and they wait a little too long, you can still sell your stocks any minute of the day. But once real estate starts going down, especially the high end, it gets very illiquid quick, and you can't even sell it to anybody. That's the problem with real estate. So I tell people, real estate will not go down as soon or as fast as stocks in this next correction, and the stock correction's already started, but you'd be better to sell your real estate sooner, because once it starts getting weak, you really have a hard time selling it to anybody. When the Chinese aren't buying in Vancouver, who are you going to sell that $10 million condo to?
Well, what about the fact that the greater Vancouver area has anywhere between 23 and 50,000 people a year moving to it?
Yeah, well, that's great. But what happens when that stops? I tell people, do you realize that in the roaring 20s, early 1900s, immigrants were moving in the United States and Canada at the fastest rate in all of history, and by the early 30s, immigration dropped to, guess what? Zero. When those immigrants stopped coming because people don't want them, because the economy's down, or because they no longer see the opportunity in the new areas they're moving to, and when the Chinese wealth implosion happens, and Chinese can no longer come to Canada and say, I've got $500,000, so give me a visa. When they don't have that $500,000, or when real estate is collapsing in China and or Vancouver, are they going to do that? And my answer is no, they won't. And immigration in the United States from Mexico has already been near zero in the last several years. Trump's talking about building a wall. I'm like, why do you need to build a wall? They're not even coming anymore. More people are leaving. So, yes, you can say, Vancouver, people are moving here. Well, how long will that happen? And who can move there when the average house is a 2,000 square foot near trailer selling for $1.1 million? How many people can move to Vancouver when you pay over $1 million for, I hate to say it, a crappy house?
And this year, too, in BC, we've seen the property tax assessments come out, and some people are looking at property tax bills that are 30-40% more than last year.
If you look at it from the outside position and say, is it good for a city like Vancouver or New York or San Francisco or Sydney, Australia, to have higher and higher real estate costs? No. It's a higher cost for the living of the workers. It's a higher cost for businesses that have to pay those workers. How can it possibly be good that real estate keeps going up? It makes your city, your country, whatever you're in, your region, less competitive. It's a bad thing.
Well, I recall...
That's when bubbles burst. Bubbles cannot sustain themselves. Things cannot go up exponentially. Stocks, real estate, gold, commodities, anything, without bursting. Because they have to come back to reality.
I recall back in 2007, people thought that real estate would go up forever. What's the experience when you have a housing collapse like happened in the U.S. in that time?
You know what? People still don't get it. I moved from California to Miami in 2002. I saw the real estate bubble in California building, and it was super expensive. Then I moved to Miami, and I'm like, oh, my God, I can't believe how big a bubble this was. It came later. I warned 100 couples, because my wife, who I met there, knew everybody in Miami. I warned over 100 couples and households that their real estate was going to go down, and guess how many people sold their real estate?
Nobody.
Zero. The only person that did listen to my advice was my ex-wife in California. She sold her house at the top of the market because she knew I knew what I was talking about. Everybody else was like, oh, Harry, you don't understand. We're in Miami. Miami has no real estate to develop. There's ocean, there's Everglades, and everybody wants to move here, and we're the hottest place in the country after New York and Manhattan. I'm like, you don't get history. The hottest places, including Manhattan in 1929, when real estate collapsed in the 1930s, it was New York that went down the most and took 10 years longer than the rest of the market in the United States to even start to bottom and come back. And everybody would have thought in 1929, Empire State Building, you got a condo there or an office there, you can't go wrong. And that's what people think today. I just bought a $20 million, 5,000 square foot piece of crap condo in New York, and I can't lose money because the richest people will always want this. No, the richest people lose the most money when a bubble bursts. Nobody gets that. The Japanese bubble burst, and they lost all their money. The Chinese have a lot of wealth around the world. They're going to lose all their money. And Chinese, more than the Japanese, more than U.S. affluent, have 80 to 90% of their money in real estate. So when the real estate bubble bursts, they are going to be poor overnight. Rich people are going to be poor. And they're not going to be buying $20 million condos in New York anymore, or $10 million condos in Vancouver, or $1 million condos for 400 square feet in Vancouver, which is absurd.
Harry, with this demographic bubble now facing us, and you have an excellent book on it, what are some of the highlights of the book, and is there any way for a person to protect themselves from this thing when it does blow up?
Well, I mean, two things. We call it the demographic cliff for a reason, because it's happened in different countries and regions around the world. Japan was the first baby boom to peak between the late 80s and mid-90s, and I was the only person in the world that said Japan was going to go down in the 90s while the U.S. and Europe and most of the world boomed greater than ever. But it's just demographics. People spend money at predictable ages, and demographics is the way to predict that. And it's the only predictable thing in economics, or one of the few things. But the other thing that has happened since is that we've had debt bubbles. I mean, when the economy gets better for a long period of time, like the 80s and 90s and 2000s, banks get more liberal, governments, push interest rates down, they encourage more people to own homes, everything gets more stimulative. And we've had the greatest debt bubble 2 to 3 times what we saw in the Roaring '20s, the last great debt bubble. And debt bubbles always cause asset bubbles in housing and stocks and commodities and stuff. And when those bubbles burst, money that was created out of nowhere from debt and assets inflating disappears. And all of a sudden you have a deflationary crisis. And I always have to emphasize this, Jim, with people that people don't know what deflation is. All of our lives as baby boomers, we've seen higher home prices, higher prices for everything, oil, everything, cars. No, we're going to see a deflationary period, which we already started to see in 2008 before governments stepped in and inflated to prevent it temporarily. We're going to see deflation, and when deflation happens, stocks go down 60, 70, 80%. Home prices go down 50, 60, 70%. Commodities, we've already seen oil go from $147 to $32 recently, and we predicted that years ago and nobody listened to it. We're in a deflationary era. All these bubbles in commodities, real estate, and stocks are going to deflate. And so the simple solution is to get out of assets. If you got a home worth $1 million in Vancouver that's 1,000 square feet and looks like a trailer, sell it while you can at $1 million, because it could be worth $300,000 6 years from now. If you got, Google stock worth $800, it could be at $200 in 2, 3, 4 years from now. Sell it now, convert it to cash,
And when these bubbles burst, and real estate will take longer and stocks less long and different things, when these bubbles burst, then you rebuy. And that's the best way to build wealth in the shortest period of time. I always tell people, we're going to have this winter season, this bubble burst like the 1930s, which nobody knows because nobody was alive back then. But I said, if you see it coming, it's better than a bull market. Because in 3, 4, 5, 6 years from now, you could buy the best real estate in your country, the best stocks and companies at 10, 20, 30 cents on the dollar. What could be better than that? So nobody's seeing the opportunities in it. They're just seeing, when I say, stocks could go down 60, 70% in the next year or two, and they could go down 70, 80, 90% in years to follow, people say, oh my God, that's horrible, and you're bearish. And I'm like, hey, you got to remember first, I was the most bullish economist in history from the late 80s forward, because I saw this baby boom coming around the world. But when this deflation happens, it's the sale of a lifetime for financial assets, and nobody sees that opportunity. And that's how Joseph Kennedy, in just 3 years, created a huge family fortune by simply selling all his stocks and assets at the top in 1929 and rebuying similar assets when they crashed into 1932-33. That's all he did. He just got out and rebought. 3 years, created a fortune, which his family has still not spent down despite all of their attempts to do so.
The migration scandal or crisis, I think it's both, in Europe, 1 million people moving there, and then they expect perhaps another million. Would countries like Canada, Germany, smart because they're accepting those refugees? Will that help?
Well, I mean, here's the thing. Most of the developed world, the United States, Canada, Europe, especially Southern Europe and Germany and Austria and Japan and East Asia, have huge demographic deficits. I mean, their workforces are all going to slow for decades ahead in their population and their spending. So they need immigration. The problem is, if you're in Europe and the immigrants are coming from North Africa and the Middle East, they are different religions. They do not speak your language, unlike people coming from Mexico into the United States that often do speak our language, and their children always do afterwards, and they have similar religions, Christianity. These people are very hard to assimilate into your economy, and even if you do eventually simulate them in your economy, they're going to cost you for many years. So this whole migration into Europe is a short-term disaster from my point of view. Merkel has already had to back off on it. At first she's saying, we should let them in. And of course, after the Paris attacks, people are like, yeah, for every 20 that come in, one terrorist is going to sneak in with them, and we don't want them. And that's predictable. It's unfair to these migrants, but that's the way it is, and they're having to back off on this. So to me, yeah, 10 to 20 years from now, if these migrants do continue to come in through Turkey and Europe into Southern and Northern Europe, they will help to some small degree, and it is a small degree, offset their demographic decline. But, the expense in the next 3 to 5 years is going to be way more than anybody could calculate, and it's not a good thing for Europe at this time. We're lucky we don't have this happening in the United States. We're only going to get a tiny percentage of these.
Does the U.S. have more positive demographics because of the large Latino immigration?
Yes. I mean, and I've said this for years. The immigrants from Mexico and Latin America have come into our country for decades. Now, it's tailoring off very rapidly now, so it's not happening. I don't think we need to build a wall because it's already not happening. But for decades, these people come in, they are younger, number one. They are workforce age, average 23 when they come in. They are ready to work, they produce, and they are not largely on welfare or on health care and stuff like that. They are a plus, and they take jobs that most of our workers would not want. Now, that will shift, and I've also predicted for decades that when we go into this downturn from 2008 to 2023, I call it the winter season, that immigration will decline, both because the present workers in this country say we don't want people coming in from Mexico or Latin America or even Asia because they're taking our jobs, and now we do want those jobs we didn't want before. And if you're going to take the risk and expense, and it is hard to come into a country like this and cross the borders legally or illegally, even harder, illegally, they're going to say it's not worth it. So immigration has already dropped, and it will go to near zero for the next several years. And in the future, we will wish we had had more immigrants because they are younger and they have more kids and they do things a lot of us are not willing to do. It is a plus for our economy, and it has been a plus. And I agree with Donald Trump on a lot of things, but I disagree with him when he says I'm going to deport 11 million illegal immigrants or more. We would have a depression over that one move alone, and it would cost trillions of dollars to find these people and move them out of the economy, and we would see jobs disappear, and we would see spending disappear. It would be the worst thing that ever happened to our economy to suddenly deport 11 million plus people. So that is the craziest thing I've ever heard.
What are your predictions for this new year?
I hate to say it. I think, and I just put out my newsletter in January. I said, I think 2016 is going to be like 2008, only harder and stronger. It's going to be the next crash. And you got to remember, every bubble we've had peak in early 2000 and late 2007 and now in mid 2015, every bubble has gone higher, especially with more and more stimulus. Every crash has taken us lower. Nobody's seeing that. And I keep saying, hey, look at this chart. Look at this megaphone pattern, I call it. And the Dow peaked at 18,350 something. And I think by early to mid 2017, if not earlier, it's going to be down at 5,500 to 6,000 because it's just going to be a slightly lower low. It's not a big deal, just lower than we saw in late 2002. And I called that bottom down to almost the day. In early October, I said, if you don't buy here, the market's going up. You'll never see a better buying opportunity than this. Well, now I'm saying markets are way overvalued. We got the third bubble, and I think the last bubble. And when the next market low comes, and it won't be the final low, but it'll be the biggest crash, I think it's going to be early to mid 2017. And it's going to be between 5,000 and 6,000 on the Dow. And that's going to be a 65 to 70% drop or more. And people are not going to see it coming, and they're going to go, oh, but the government finally told us they wouldn't let the economy go down. And all the economists said, 2016 is going to be almost as good as 2015. Well, first of all, 2015, stocks went nowhere for the first time in 7 years. People never see bubbles bursting. My biggest campaign is not educating people about demographics and booms and busts, and it's people don't understand bubbles, because when people get in a bubble and their real estate's going up faster than usual and their stocks are going up faster than usual, they're getting a high. They're getting something for nothing, and nobody wants it to end, so they go into denial. Bubbles always burst, and this is the second biggest bubble in our lifetimes, only second to the tech bubble in the early 2000s, and it's going down in the next few years. And I'm telling people, just get out of the way. Just be safe for the next year. If I'm wrong, you might miss 5 or 10% gains in the market. If I'm right, you're going to miss 70% decline in the markets. I think it's better to lean towards protecting against the 70% decline.
Harry, how can people find out more about Dent research?
Well, it's really simple. HarryDent.com. My book, which just got updated in paperback, The Demographic Cliff, people can get for free. They just pay $4.95 for shipping, and that is really our cost. This is not, shipping and handling. No. We pay for the book and we ship it to you at cost, $4.95. And you can click on the right upper end of the website and get a free daily newsletter called Economy and Markets. And I tell you, it's a darn good newsletter. And, of course, we have other newsletters and other services, but our newsletter is simply to get you to see how we think and see how different we think. We explain the economy not in economic terms. We explain the economy in what people like you do as you age. Well, good luck in Vancouver, because it's my favorite city in North America, by the way, but it's also one of the most overvalued in real estate.
Harry, thanks a lot for chatting with us.
Yeah, great to be back on.
My guest has been Harry Dent. He's the author of The Demographic Cliff, and also you can get his free newsletter, Economy and the Markets, by going to his website, harrydent.com. Coming up next, Larry Reaugh on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Larry Reaugh, CEO of American Manganese. We're discussing how the lack of an uptick rule and overregulation is strangling Canada's junior equity markets. Welcome to This Week in Money, Larry.
Well, thanks, Jim. I'm glad to be on.
You wrote a major article in the Vancouver Sun about how important the junior equity markets are to Canada. They really are the power behind our economy. Can you maybe explain how important it is and why this overregulation and lack of an uptick rule is hurting us?
Okay, I can't expound on that more, but I also want to caution that without an uptick rule, all our industries and technologies and everything that trade on the Canadian exchanges are in problems because they're all subject to being shorted. And I think the poster child for it all is mining, because there's a double-edged focus there, and that focus is you can manipulate the prices of commodities, right? Glencore president came out and said, the fundamentals are not working, the stockpiles are dropping, and yet the price of copper keeps going down, and which doesn't make sense. And this has been going on for 5 years. So, again, the financials overwhelm the market. And what it does, it trickles down to the companies themselves. And the first to be hit were the more illiquid companies, which are the Toronto Stock Exchange Venture. And we've seen the results of that. They can't raise money. Good projects have been lost. Good projects have gone into the Never Land. And now we're seeing the effect on our intermediate companies, which are, some of our operations out there that we used to call mid-tier are now trading like a junior with a greenfield project in 2009 or 10, trading at 25, 30 cents, 40 cents. These are producing mining companies, and the big ones like Teck back down to almost to the lows of where it was at in 2008. Some of these companies have debt. Anglo American laying off 85% of their 85,000 people and having debt, uncertain whether they're going to survive. You could say the same for Teck or for Freeport or any of those big companies. All the mining companies are being affected. If we just look at that, I think there's probably been, directly and indirectly, just through the Vancouver Exchange, 100,000 jobs lost.
Well, Larry, you said even your own office, you had a major layoff. You just couldn't afford to keep people anymore.
That's right. I mean, virtually, we've laid everybody off. I haven't been paid for years. I have a director that comes in, Mike McLeod, and donates his time several hours each day, and we keep the company alive that way. But before, we were a major employer in this province. I mean, we had feasibility studies going, huge drill programs going. At any one time, we could be responsible for paying out 50 engineers and drillers and everything else just in an employee-wise, and our employees were 10 or 12. Now we're down to nothing, and unfortunately 90% of the other companies are like that.
Larry, so what has the lack of an uptick rule done to our markets, and why is it important to bring it back?
Well, it's like I said in the article. When you take away the uptick, which means that you had to borrow the stock and sell it on an uptick, which means if it was trading at $1, you couldn't sell it unless it went up to $1.01. Then you could make your trade, right? Now there's no uptick rule. No uptick rule basically says that you can hit the bids, and the borrowing requirements are nebulous. So a lot of these companies or a lot of these traders don't even borrow the stock, and they just hit the bids, overwhelms the buying. And what happens is the investor goes in and he'll buy, for example, let's say that a company announces a very positive feasibility study, and the shareholders and new investors look at it and say, hey, this is a good deal. You know, it's trading at 25 cents, and they've got a internal rate of return of 18 or 20%, net present value of $1 billion. This has got to be a good buy. So they go in and they buy the stock, and they buy several million shares. Predators love that because they're buying the predators' shares. These are the short players that are selling shares short. They're not shareholders, and they just keep drumming it down until at the end of the day, the stock, which may have gone to 30, closes at 20. Next day, it closes at 13 or 14. By that time, the guys that bought it at 25 to 30 say, hey, we made a mistake. The market doesn't like this play, and they sell. And that's exactly what the predator's hoping for.
Larry, is there a website people can go to learn out? Is there a website people can go to learn more about this issue and why it's so important?
Well, there's no specific site for it, but you can Google Uptick rule and see how, that basically that has been repealed. You got to remember, Jim, Roosevelt brought in the Uptick rule and got the banks out of the brokerage business back in the early 30s. And 1938, they brought the Uptick rule in because they couldn't get investors back in the market because it wasn't a level playing field. When you have bad times, that's when the predators come in and any blood in the water, and they go for it, and they short the stock, so investors can't make money. So they brought the Uptick rule in, and that's what brought a semblance of order and restored investor confidence. And we had that for 80 years. And then the U.S. decided to drop it. 2007, I don't have to tell you, everybody knows historically that 2008 was one of the worst years we've had, and I have to tell you, it doesn't compare to what's happened after 2011 in our market. But basically, the U.S. was forced to restore a partial Uptick rule, where you can only short down 10% in the day. That in itself can be problematic in weak markets, and you're seeing it today. But the Canadian authorities decided to get rid of the Uptick rule, and it was approved in 2011, and finally became a fact in 2012, and we've seen nothing but losing ever since. I mean, even the Toronto Stock Exchange is down to the third ranking, or the third worst performing exchange out there.
Has the Trudeau government shown any interest in changing this?
I don't even think they're aware of it. It seems like I've been talking about it for a long time, as you know, Jim, but most people are not really understanding the fundamentals of what not having a short rule in place, how that can raise havoc in the markets. You know, our whole economy, the Canadian economy, is really circling the drain right now. This has a knockdown effect, and it's not just the mining, oil and gas, technology stocks. It'll soon hit it's already hit some of the big pharmaceuticals, and you're seeing the results because of the poor performance on the Toronto Stock Exchange. This all results in loss of jobs. So we're losing all the good-paying jobs, and the only jobs we have left are the minimum pay jobs. And that's not going to build a very solid economy for Canadians.
Larry, thanks a lot for chatting with us.
Okay.
My guest has been Larry Reaugh, CEO of American Manganese. That wraps up our show for this week. Thanks to our guests, Ross Clark, Harry Dent, and Larry Reaugh. And thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.